Hi guys, so in today's video I'm going to be answering the question how Forex trading works, and I'm going to be going over it so that if you're brand new to trading, this is going to be great information for you. Or maybe even if you just want information, maybe you're considering trading, you're going to actually understand what you would actually be getting involved in. If you have been trading for a while already, or you have some experience, then this is probably not going to be information that you might benefit from. You never know, you might pick up something new. But just bear with me as I go over the questions and answer the questions until I get to that point where you could actually learn something from the information that I'm sharing in this YouTube series. Alright, so how the Forex market works is simple. Let's get into it. What I have in front of me is a chart here. It's called a Japanese candlestick chart. And all that you're seeing, we call each of these that you're seeing candles. You'll see some are very big, some are small, some have a line coming from them which we call a wick related to the candle. Alright, and all they do is measure the change in price over a period of time. If you watch the sides of the graph, so the axis, you would see that this side here has price points, which represents price, and at the bottom here there's dates that represents time. So when you come to the Forex market, you're going to pull up a chart like this and you're going to see price versus time. So if, for instance, let me zoom in, this big candle here, all this means is that when this forward period started, because I have the forward chart open here. So if I change it, you could change the time frame to daily, hourly, 30 minutes, but we're using the 4 hour for this example. Within this 4 hour period, this market dropped 66 points or pips, right? However you want to call it, that was the change that happened over the period of time. That's what each of these candles measures. So the smaller ones just means that they moved less within that 4 hour period, and the larger ones means that those moved more within that 4 hour period. As a trader, what you want to capture is movement. Whether the market is going up or down, your aim is going to be, how do I enter this market to execute a successful trade? What you do here is we would be trading the euro versus the US dollar, because that's the chart that I have up. And what I'm actually trading is simple. It's the relationship between Europe and the United States represented by this chart. So as of right now, this is going down. You could see we had a big fall here. So that means that the euro is weakening against the dollar, which is the second pair. Euro, US dollar. That's how we break that down. Or it could also be said in reverse. The dollar is strengthening against the euro. Now that could be a little bit confusing, but what you will notice here up in the corner, it's that we have a EUR USD. So EUR is the euro, USD is the US dollar. And what I just explained there is basically for you to understand that if the euro is the first pair, then whatever this chart is doing represents what the euro is doing against the dollar. And if you say it in reverse, you will be taking this perspective of what is the dollar doing against the euro. So if this is falling like this here, the euro is weakening, right, or is being weakened against the dollar, and the dollar is strengthening against the euro. That is the relationship between these two. All right, so once we understand that and we get into the charts, if I go back, we could see on this side the euro was strengthening against the dollar because it was going up. We could see we had some nice bullish or upwards movement here. Again, upward movement here. Now we seem to have downward movement or bearish movement where the market is beginning to fall. So we don't know how far the market is going to fall. We might have an idea. All right, but basically that would require us to get into deeper analysis. But for now, all we're looking at is understanding how does it work. So what we want to do here, when the market is going up, we want to buy that market. So as you can see here, as it's going up, the market waves. And this is something that you need to understand. The market never moves in a straight line. The market will always wave, but in a direction. So if the market is going up, you're going to see a push a correction, a push, a correction, push, correction, push, correction, as it works its way up. If it's falling, you're going to see the same thing. So you see like how we just had this push here, I expect a correction and a continuation. Correction and continue. That's how the market will fall, and that's how the market will go up. Our aim as traders is when we do our analysis, we want to see, is this market going up? Yes, then I want to look for opportunities to continue to buy this market. If the market is falling, I want to look for opportunities to sell the market. I know selling the market is confusing to most traders, but this is what I want to tell you. This is how you need to pay attention to it, or this is the way that I was able to break it down and understand it. When the market is going up, think of it as a traditional business. Buy low, sell high. So when this price point here is at $5, let's say, I want to buy it at 5. When it goes to 10, I want to sell it, and I would have made the difference, which is $5 profit. That's traditional business. So buying the market is usually easy to understand. Selling the market, however, to me, you need to take the approach of the Amazon business model. Alright, and Amazon is not the only company that does this, but I'm just using them for example because they are one of the most popular. Alright, Amazon does not buy all those products that they advertise on their site. They don't purchase them upfront like a traditional business where we did on this side here. Amazon has contracts with those suppliers of those items. The suppliers advertise on Amazon. When you place an order as the consumer, you buy that first. Alright? You buy it. But Amazon does not buy it as yet. They basically sell it to you first. So you have to now switch the role. Amazon sells that product to you first, and then goes and buys it from the supplier based on the contract, and then ships that item to you. So only when you place that order does Amazon go and fulfill that order with the supplier, and that is selling the market. You need to think of the Amazon business model. So they sell that to you first for $10. So if I think the price of this market here is going to drop and it's at $10, I sell it at $10, creating a contract with my broker that guarantees that sell price. As long as the market falls, I then, like Amazon, I'm now going to go back to the supplier to fulfill my contract at the $5 price that they guaranteed I would be able to buy it for. And I buy it at the $5 and I make the difference. That is going to be the easiest way for you to understand selling in the market. Always remember the Amazon business model. They sell to you first, they then buy from the supplier, still making the same $5 profit based on the example that we use. So you could buy it first at 5, sell it at 10. That's traditional business, you make $5 profit. If the market is falling, you're going to sell first at 10. You have your contract to buy at a lower price with the broker. When the market falls, if it falls to $5, you're going to capture the difference. 10 minus 5, you're going to make $5 profit the same way. That's how buying and selling works in the Forex market. So what you want to be doing as a trader is looking for those opportunities where if the market is going up, you want to be buying the market to capture that positive change. If you predict that the market is going to fall from the charts again, then what you want to do is start looking to sell and applying what I just explained. And the aim is to have a positive pips difference. That's how it works. So a pip is something else that you are going to need to understand. A pip is just how we measure the change in currency. So on the side here, you could see that this point here says 1.2150. And right above here, it says 1.2173. A pip is simply 1/100th of a penny. So 0.0001. So in this example here, if the market moved from 1.2150 to 1.2173, then the market moved 23 pips from 1.2150 to 1.2173. That is how it is. You just minus the difference and you will know, and it works the same way either way. So if the market, you put the bigger number first and you just measure. So if we were selling, you could see here, if I sold up here at 1.2189, let's say, and this is where the market fell to, 1.21 28, that's about 68 pips difference between here. And that's what you want to do. When the market is falling, you want to sell first and buy back at a lower price. When the market is going up, you want to buy first and sell later at a higher price, capturing the difference in the pips. And focus on pips, especially when you're a beginner. I want you to focus on pips, not necessarily the money, because you see, trading has an emotional side attached to it as well. And when you focus on the money first, it tends to throw you off. If you focus on the pips, once you are making pips, you would be making money. But the pips we tend to treat pips more as a calculation, where the money plays on your emotion. If you're down $20, sometimes you want to jump out of the trade, and that might not necessarily be the good thing. And same thing, if you're up $20, you might say, no, I'm just taking this, and the market goes on to make $100. So it is all calculations in terms of, once you do analysis, you will know where to exit. But once you start from the beginning, right, and you have proper expectations, then it makes it much easier for you to follow the rules as you go along trading, guys. And that's something we'll discuss in more detail later down the road in this series. But I hope this kind of gives you a basic understanding of what trading actually is and how Forex trading works, guys.